Welcome to the Value Investor TV podcast. This is the podcast that helps you grow your wealth and become financially independent. My name is Becco and my partner, Hari.
Hello.
This is part 2 of Boeing. So if you haven't checked it out, part 1, go check it out before you listen to this one. Got some good stuff in the previous episode. All right, Hari, start us off with a disclaimer.
Yeah, this is the Value Investor TV podcast. We are a podcast that helps you understand the concepts behind value investing. We are not financial advisors. We don't know your specific financial situation, so please consult with a appropriate advisor before making any investment decisions.
Awesome. Just 3 things really quick. Checklist. You guys want our checklist? Email us. If you want to be in the Slack channel, email us. If you'd like us to review a company that you have in mind, email us. All those things, email us at info@valueinvest.org.
Awesome.
All right. Let's go right to it.
Yeah. So, in the first part, we talked about the business side of Boeing, and we kind of identified that they had a strong moat and the had a durable competitive advantage, but there were some risks associated with the 737 MAX and their reputation. But we, now that we understand the business, we kind of talk about the moat as it applies to a return on capital. So Becco, tell us about which metric you wanted to use here of the return on capital metrics, and if you are not familiar with those, we'd recommend listening. A few podcasts ago, we did a podcast about the various types of return on equity, return on capital, and so on. So we'll refer you to those if you want more info. But Becca, what do you think Boeing's return on capital is, and which metric did you think was the best to use?
Yeah, so I used return on capital employed.
Okay.
Because if you look at the balance sheet, you'll notice that equity base is very, very small. And if you further look into why that is the case, and that's because they have a huge liability. And you might think that, oh, wait, their debt base must be huge. They must have, piled on a huge debt. And to some extent, that is true. But, for a company like this, they've actually quite managed debt level quite well. And so the reason why the equity base is so small and the total liability is huge is because of their business. Again, this goes to show why you have to really understand the business before you look at the numbers here. That's the breakdown of the checklist. We start from the qualitative and then go into quantitative. Now, their business is they're in the business of building plane and then selling planes. And planes, of course, they're not $10, they're not $20. They're in the hundreds of millions of dollars. So what happens is in the transaction, let's say United wants to put in an order for 10 Boeing 737. They pay in advance before they actually get the plane. So when I pay Boeing, and let's say I'm Southwest Airlines and I pay Boeing $200 million, that $200 million is booked as a liability because I haven't received my planes yet. My planes come 10 years later. And that is why their liability base is so huge, because they have all these orders that they've collected over the years, and they're booked as a liability because they haven't delivered the planes yet. Therefore, the equity base is so small. So going back to the question of return on capital employed, ROCE is what I use. And again, we always ask people to use multi-year number because of 1-year fluctuation can really distort the numbers. So if we do that, you're looking at a company that's generating return on capital employed at about 16%, 16 to 20%, I would say is the range there. So
okay,
that's the number.
All right. We'll move on to this to the next section here, because 16 to 20% for a capital heavy business is pretty darn good. But from a financial standpoint, we just talked a little bit about the cash and the debt level. Tell us, how much cash do they have, like, current ratio, things like that. Does that, are they going to be at risk of running out if they have such a huge current liability? And then tell us a little bit more about the debt level.
Yeah. So right now they have again this is going by their 10K in 2019, their 2019 number. So on their balance sheet they have about 9.5 billion dollars in cash. And in terms of debt, just in the classical sense, them borrowing money, they have about $27 billion booked as debt. Now, if you look at current ratio, you just want to make sure that it's not too heavy in terms of liability base, so that they're able to pay out if shit hits the fan. So current ratio, you're talking about 1, which is pretty decent. But I also like to look at this number, quick ratio. Quick ratio takes into account basically same thing as current ratio, and then you subtract inventory out of the current asset. And so because it makes sense, right? If actually shit hits the fan, you can't just quickly liquidate inventory and turn them into liquid cash and pay off debt. You can't do that. And so quick ratio is if really shit hits the fan, this is what you look at. And quick ratio is about zero point 0.3. It's been about 0.3 for a long time. So, from that standpoint, they have, they have, 3 times as much liability as really liquid current asset.
Okay.
So that's that. And then, again, kind of traditional method of evaluating debt level for us has been always free cash flow versus debt. And you always want that number to be below 3. And in fact, for a company like this, I was expecting just debt to go up insurmountably. But in fact, they've done quite well in terms of maintaining that level. So excluding last year because of huge Max 737 accident, stuff like that. If you look at debt divided by free cash flow, you're looking at around 1.
Okay. So not
which
not
which
not
is quite healthy.
yeah, not too bad. Okay.
Mm-hmm.
So let's you mentioned free cash flow, so kind of give us how has that been for the last few years?
Yeah, so free cash flow, let's take a look. Again, we have to sort of exclude 2019. 2019 just has been a horrible year, and then probably 2020 as well because of COVID. If you look at free cash flow, you're looking at about 13, or I guess previous year, 2018, they generated about 13 billion. Year before that, 11 billion. Year before that, 7, 6. So they've been growing free cash flow quite nicely.
Okay.
Ever since the recession hit in 2008, they sort of, they hit rock bottom in 2008 with -2 billion free cash flow, and then rose up all the way to 13 in 2018.
Okay. All right, let's shift gears a little bit here. We talked about the financials and the business. We usually do a cursory look at the management of a business to make sure that management is doing the right thing with our equity or our cash, and the excess capital in this case, and kind of looking at their incentive structure to see what are they aligned with shareholders. So, kind of give us your take on management here.
Yeah. So one of the things that we love to look at is total shareholder return, and what we mean is summation of stock buyback and dividend. You add those two up, and you divide that number by free cash flow.
Okay.
And what that tells you is that are they doing these things, shareholder return, an actual cash payment or stock purchase, with free cash flow? Are they doing it with that? And one time one time spike is no problem, but if they're consistently, going into the negative just to pay out in terms of dividend or just to purchase extra stock, that sort of is a red flag. And so if you look at that ratio, that number has been, pretty consistently negative. But I found this kind of interesting, and this might be a trend that we've been seeing for a long time. If you again, Boeing has been around for a long time, so we have all this data to play around with. If you look at from 2000 to 2010 and look at the number of years that that ratio went above one, so meaning they spent more on total shareholder return sort of thing than they had left. It was zero. They had no years from 2000 to 2010 that they did this. Now, turn the chapter over to the previous decade, from 2010 to 2019. They had 4 years where they dipped into, or they had more cash paid out in terms of stock buyback or dividend than free cash flow for 4 years out of 10. So it's not necessarily a bad thing. I just think that this is a trend that we've been seeing in many companies. Um, so
And what do you see in as far as the management? They have relatively new management after 737. So kind of talk us through what you see there and what you like and don't like.
yeah, so from incentive structure standpoint, it's always important to look at this to see how they're incentivized. Um, if you look at that, they're incentivized. Their performance is judged in four categories: free cash flow, revenue, earnings per share, and then total shareholder return. So again, free cash flow, revenue, earnings per share, and total shareholder return. I like the fact that they're looking at free cash flow. In fact, I think it's a rare occasion that people actually are pegged, their performance is pegged on free cash flow. And so I would say, this is a good sign. And as you mentioned, Hari, they had a huge sort of turnover in terms of management. From the Max 737 incident, and so we have a huge, you have a huge, different cohort or new cohort of leadership and executive ranks in Boeing. So we'll see how they do, in the coming years. Just to keep in mind that the guys who are running Boeing now are sort of new.
Okay. All right. So I think we've answered, a lot about the company, the financials. I think we're at this point, the question that we have to look at is valuation to see, is this a worthwhile investment? And as we talked about, we don't buy companies that are at or near their value. There has to be a significant discount to their valuation, which we call the margin of safety. So tell us what estimates and assumptions you're using in the model, and then kind of give us your take on your valuation.
Yeah. So again, I just always like to preface this by saying that free discounted cash flow analysis, you can really fool yourself into thinking that this is a precise number and you can stick with it. If anyone has done any sort of analysis on using this kind of cash flow, you can really change the numbers based on the assumption. So really, assumption is where everything is. So what I did was last year, free cash flow went into negative because of Max incident. And I suspect that 2020 is also going to go into negative because of COVID. And so it's really sort of difficult to use that number as a starting point.
Mm-hmm.
So what I did was I went back to the recession time. Again, this company has been around for a while. We have all this data to play with. So I went back to the recession time, back in 2009, 2010. Their free cash flow once, dipped into negative, but then they recovered to about $2 billion in free cash flow. So I thought, maybe that's a good starting point there. So we start with that. So $2 billion in free cash flow, start with that. And then again, we always use 10% discount rate. So from first year to first 3 years, so from this year to 3 years later, I would say overall on average, I think the growth rate you probably look at somewhere around 3 to 5%.
Okay.
Right. And then from there, it might go up a little to about 5%, but I don't expect them to, to experience kind of explosive growth at all. Right. This is a mature business. There's only so many customers out there. So I would expect 7 to 5% there for the rest until the termination.
Okay.
So if you put in these kind of estimate And again, share outstanding, debt level, cash level. Put in the formula. Intrinsic value per share. You're talking about about $50 to $40 per share
Okay.
is intrinsic value
All right. And what are they
per
trading at?
share.
What are they trading at right now?
They're trading at right now 180.
Okay. So that was based on an assumption of $2 billion in free cash flow.
Yep.
So if you look at the last like 4 or 5 years, that number has been as high as 10, right?
Yeah, for sure.
So what if we started with a more normal assumption of like 6 to 8? How does that affect the model? And
Let's try that. We could do, I think we could comfortably say 6,
yep.
Sorry, I'm just putting in the formula. If you start with 6, you're getting about $100 per share.
Okay. So, I mean, in order to be, reasonable, right? I think, I think your growth rates are pretty, conservative, which is what we would want to pick. Let's say in the best case, that the real free cash flow was closer to 10. What would that look like?
Again, yeah, I just want to preface by saying that this is like the best case scenario for them, right?
Yep.
Because they hit 11 and 13 in the last couple of years. They did in 2017 and 2018. They did that.
Right.
But this was like the only time they actually did that. In the past, it was all single digits. So best case scenario would start with initial free cash flow of 10 billion. Then you're talking about 150.
Okay. So I mean, at this, if Boeing went on sale today for $50, $75, remember that this is not a growth business, right? You may get paid back in free cash flow, share buybacks and so forth. But is it really worth, putting your capital at risk for a business that is essentially grossly overvalued at this point, right? In the best case scenario, it's still overvalued, right? If we assume to grow, a stable free cash flow of $10 billion.
Yeah. And, to me, it's like we said, these growth rates, I think it's pretty, conservative growth rate assumption, especially given COVID and especially given Max 737 incident. But, I think, who knows what's going to happen? To me, it's very difficult to predict.
Yeah.
When is the inflection going to be? I'm sure things are going to go back to normal. I don't think anyone is challenging that.
Yeah.
But like, when is that going to be the case? I think.
Well,
and that will substantially make a huge difference in terms of your valuation calculation.
Well, and I think it's also, it's probably not going to be 2020. It's not, it may take till 2022, until you see, a decent amount of free cash flow again. So, to me, the problem that I have with businesses like this is that we're using very conservative numbers, right? So there's no point in my mind of using aggressive numbers, right? Because I think as soon as you start doing that, you can say, well, yeah, I mean, I'll use a growth rate of 7 or 8 to 10%, use, $12 billion because that's the last good year. And, I'll lower the the interest rates are so low, so we'll use a lower discount rate, right? So in our, the whole point of being conservative with this is that you want to err on the side of caution. And then on top of that, you have a margin of safety so that even if you screw up your assumptions, you're a little bit too aggressive with your assumptions, you have a built-in buffer to still make a decent amount of return, right? And, I think the investment community, the value investing community has missed out on, a lot of the bull market because they've been very conservative, right? And we've all kind of expected the tables to turn, right? In terms of a recession to hit. But, one of the challenges that we have seen in the last 10 years has been this interest rates have been so low, right? So if you look at some of the people like Seth Klarman and these traditional value investors, they've held their traditional kind of portfolio, but have lagged the market over the last decade. But if you look at value investing over the long haul, right, it's the only strategy that actually makes sense, right? Because a lot of these people who are bidding up Tesla and Amazon and so forth, that doesn't mean that they're bad businesses necessarily. It's just you're way overpaying for what they have, right? And a company like Boeing doesn't have a lot of growth to fall back on, right? And so I just don't know how it's going to continue to operate in this capacity. So at such an expensive price, right? Because all things will change, in a recession type environment.
Yep. And I wanted to point out also that, I think we've been getting some complaint that every company that we look at, we say no to, except maybe one or two in this podcast. But, that's the point, right?
Yeah.
You want to look at companies, you want to have a concentrated portfolio of really good companies. You don't want to own a basket of 100 or 200, right? You want to own companies that really matter to you.
And I would say that good value investors, they're probably going to be saying no 80-90% of the time or more, right? You're not going to be able to find really compelling investments every day. But the whole point of doing it is to look and keep track of good companies. And then if they do go on sale, like, we saw a huge drop in the market in March, during COVID, you have a list of stocks to go after, right? And I think, there were a lot of businesses that were on sale at that point, but there weren't a lot of people putting their money down because they were saying, well, it's going to continue to go down, right? But if you bought when they were below your absolute price, you would have made money, and could have doubled your money in a few months, So all this is to say, is the exercise here is not, we are not in the business of finding good investments every day. I would say when markets are at their peak or are hitting all-time highs, you're probably not going to find a lot of good deals. So, but that means that you put your cash in the safe deposit box, and then you wait until the pitch comes, and then you hit the ball out of the park. So,
yeah. All right. That sort of concludes our podcast in this episode. I just want to point out thanks to all of our listeners for listening and also encouraging us and sending us emails. Really, really appreciate all of that. And if you guys have any companies that you would like us to look at, email us, tweet to us, whatever, leave us comments, call Hari, get his phone number, visit his, knock on his door.
Please don't do that.
Mail him, do whatever you can to get him.
You can just message me on Slack. That's the best way to get a hold of me.
There you go. Yes, message him on Slack. Anyway, we really appreciate all of you listening. And hope you guys can join us in the next episode.
Thanks.
All right. Thank you.